Hey, how's it going, guys? It is January 30th, and this is episode 48 of Odds Are, your S&P 500 weekly market forecast. All right, well, was last week fun enough for you guys? We talked about a roller coaster ride. Remember, the week before we said we couldn't even call it a roller coaster ride because it wasn't going up at all. It was just straight down. Well, this week we got our upswing, right? So we went down further and then we bounced back up, closed the week actually positive on the week as a whole. But let's take a look at see what the chart shows. All right, so there we go. So you can see that we had a nice mix of green and red bars here, and we had a really sharp downturn to start off the week, and then just turned it around and ended up with a very large green candle. So what does that all mean? Where did we end up? Well, we did breach the 42.87 lower breach point. So yes, we had a breach of the breach points. We also stayed within the expected settlement range of 42.69 to 45.10. So we did close within the expected settlement range. We did not come close to the upper settlement limit or the upper breach point, and definitely not the 48.08 parabolic SAR. And we close within the Bollinger Band range. So that was another thing we said last week, was that look for the Bollinger Band range to expand to meet us down where we're at, and that we would also kind of make our way up to end up within that Bollinger Band range. Basically, we were going to end up in the blue shaded area one way or another. Now, what didn't happen was we looked at the tendencies on a week when we crossed over into parabolic down, and that on average it was a negative week or negative close for the week. We actually did close slightly up, not by much, but we did close slightly up on the week, and so that did not end up in the negative territory. But again, that's just an average. Doesn't mean it's going to happen every time, but it is something we definitely wanted to be prepared for. But all in all, looks like all of the forecasts, with the exception of that tendency, ended up being right on. And now we're taking a look to see what we're expecting for next week. All right, start off with the moving averages. Hey, here's a nice combination. We haven't seen two bearish moving averages, actually, I think since I started this show almost a year ago. So bearish on the short term, bearish on the medium term. It's the first time that medium term has flipped to bearish. And so we're watching this now because, does this mean that we've gotten to the point where it's enticing enough for the buyers to come in and get us back on track, or is this a sign of more downward prices to come? All right, long term is still bullish, so we haven't flipped that 50 to 200 day moving average to neutral yet. But if we stay where we're at on the course we're at, I wouldn't be surprised if that happens next week. All right, let's take a look at the price points for next week. So we're looking at the settlement range, being between 42.99 and 44.98. In this case, you'll notice that the odds are actually down. They're normally around 79.3%. This one's at 71.94, and that's because when we are in parabolic down mode, and this is getting a little more technical, when the 5-week period moving average is below the 13 period moving average, the numbers get a little wonky, and so the odds actually go down a bit because there's more volatility. It's not as predictable, so the odds are still in the 70s, but we're going down to 72% basically instead of 79% that we will settle. Now here's what's really interesting. Take a look at this spread. Your settlement range is inside of your breach points, and breach points have a higher chance of being breached. So in this case, we're saying definitely possibility that we can breach one of those breach points and settle outside of the settlement range. So we're talking almost a 28% chance that we'll settle outside of that range, but there's an 81% chance that we'll at least poke above 45.07 or below 42.73. At this point with the market and where it's at, it could honestly be either one. There's no directional bias in this case. I don't think we're going to close above that 48.04 for sure, but the settlement range, I would not stick my, all of my eggs in that basket. All right, and now let's take a look at the relative view for next week. Here we go again. See where we're at. See we're kind of into that blue shaded area, and we see where the price points are at. So in this situation, right, you've heard me talk about this before, something called a dead cat bounce. So basically, this cat has been fallen, and now does it mean it bounced up? Now, does that mean that it's alive, or is that a dead cat bounce? I know it sounds kind of dark, but it's a trading term. It's used there. It's basically when this market's going to kind of bounce up, but there's really no life left to it, and it's just going to turn back around and go back down again. Now, in this situation, given the magnitude of the downward drop, I don't think that this little blip, this little hook at the bottom there, that bounce up, is enough to qualify as a dead cat bounce. I think if we're going to get a dead cat bounce, we're going to go back up probably close to that 4,500 level and then turn back around. And I anticipate that by that point in the week, whether it be this week or next week, that red midline of the Bollinger Band will be further down. So it's setting up very nicely for us to meet the red midline, not where it's at, but where it's going to be. And then that will be the true test. If we cross above the red midline and stay above it, or if we meet it and it encounters resistance. And then if we push back down, then there we go. We're setting up to have a dead cat bounce, and down we go. All right, looking at, didn't see that one coming. All right, a couple things. So, like I said, the analysis said that the average was like a negative 0.75% on weeks following the week where we breached or closed below the parabolic SAR range. That did not happen. We ended up closing slightly up, about like 0.5% higher. Not a big deal, but looking at this, I thought we for sure, especially early in the week, that we were going to close way, way down for the week. And then it turned back around and, jump back up. But again, that's part of the market, right? We know that the market has this tendency. We know that there's a lot of people that are always waiting in the wings, waiting to try to come in and buy. And of course, people waiting to get in and sell. If this thing's falling hard, they want to try to get in there and be short sellers and make a nice killing as well. But you have to expect these things, because other human beings that are in this market are opportunists. And as soon as they see an opportunity to get this, they're going to jump on that bandwagon, and that can push the price sky high or down low. And you just got to be ready for either one of those circumstances. All right, and we're going to wrap up now with the quote of the week, who's by Mr. George Soros, who's a billionaire investor and philanthropist. Mr. Soros says, "The stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality as distorted by a misconception." Now, that sounds really, meta. That sounds pretty deep there. But really what we get out of this is that there's no coincidence in the market, right? As I just mentioned, we're talking about people that are opportunists. We're talking about traders that are thinking the same way. Not exactly, but they have the same goal. You would imagine, to make money, to take opportunities, to take risk off the table, but get paid for the risk that they do have on the table. Everybody's trying to win in this game, basically. Nobody's going into the market with the intention of losing money. But everybody is looking at the same thing. We're all looking at the same reality, right? Nobody's just imagining this world where it's the current events have no impact on the market. Fundamentals have no impact on the market. They're not oblivious to the reality. What's different is that some people's view of the reality is distorted by misconception. And whether your view is misconceived or not really comes down to how much time and effort you're spending into it, and how you're looking at the grand scheme of things. Because you can be wrong, but still have had a very legitimate conception and view of the market. It's not about being right or wrong. You just don't want to detach yourself from that reality. So for example, if last week the market went down and then jumped right back up, you have to know that that is a very, very real possibility. And if you don't recognize that, then your reality is definitely being distorted by a misconception. All right, I'll leave on that note. Looking into next week, again, we're trying to see if we're going to come back down. My thought is we're going to end up going back up towards that red midline eventually. Again, not to where it's currently at, but where it's going to be maybe in the week or two ahead. So keep an eye out for that. Until then, enjoy the rest of your week, and I will see you guys here next Sunday.